How much tax will I pay on my Social Security? Welcome to our series on taxes in retirement, and we're going to go over taxes on your Social Security, IRAs, widow or widowers, and some of Biden's tax proposals and more. To start with today, in our series on Social Security, which the link to that's in the description, we briefly went over why your Social Security benefits could be taxed. So we're going to dive into a couple situations here to show you how much tax it actually could be. And also make sure to stay to the end where we're going to go over 10 of the most tax-friendly states. So how do we figure out how much income, or excuse me, how much of our Social Security is going to be taxed? Well, first we need to figure out what your provisional income is going to be. And so what the heck is provisional income? Well, let me actually share my screen and show you guys a little what it is. So here it is. So to figure out how much of your Social Security is going to be taxed, you have to figure out what your provisional income is. And the way that the IRS describes that is a math problem. Okay, it's a math formula. And the way it starts out is, first off, let's take half of your Social Security. And here's why, because if Social Security was the only income that you had in retirement, you wouldn't pay any tax on it. It's all those other sources of income that you could pull income from in retirement that pull Social Security in and cause it to become taxable. Okay. So the first starting point to figure out what this provisional income number is going to be half your Social Security. That's easy. What's the Social Security? Cut it in half. That's your starting point. Then you're going to have to start adding in pretty much everything else, almost everything else. Ordinary income, which could be job income. It could be, if you're receiving a pension, it could be pension income. If you're pulling any money out of IRAs, it would be IRA income or 403Bs or 401k. Anything like that is considered ordinary income. Even interest on the CDs that you've got in the bank, or the money market accounts or the checking accounts that are paying point nothing, that still counts as ordinary income. And then we've got dividends and capital gains, specifically the long-term capital gains, because if they're short-term, they're already considered ordinary income. But long-term capital gains and qualified dividends that are on long-term capital holdings, those have to be added in. And also, here's the kicker that most people don't realize: non-taxable interest has to be added in as well. Non-taxable interest, what is that and where could it come from? Well, it can come from municipal bonds, and that could be tax-free from, like, that income itself is not taxed. But the problem is it can actually pull Social Security in and cause it to be taxable, which means it's actually an indirect tax. So all of those things could increase the amount of tax that you pay on Social Security. The only things that really don't would be Roth distributions or any type of loan proceeds, like cash value life insurance pulled out from, in the form of policy loans. That's about it. So loan proceeds or Roth IRA distributions. And then you have to take that provisional income. So now you've got your number and you have to apply it against the appropriate thresholds for your filing status. If you're single, 25,000 to 34,000, which means at some point, 50% of your Social Security could become taxable, all the way up to the maximum of 85%. Same way with married, 32%, or excuse me, 32,000 and 44,000. And you'll notice that it's not double for married filing joint. And so they really do kind of hammer you on taxes when it comes to Social Security when you're married. Now, here's an example of how these thresholds work when you figure out what your provisional income is. So here's an example where we're going to use, and this is the importance of having some type of a tax plan in your retirement, because where you pull your money from can affect the bottom line. So if you have $20,000 coming from Social Security and you need a total of $60,000 of income coming in retirement, that other 40 is going to come from, in this case, an IRA withdrawal. So you take half your Social Security to come up with that provisional income. So that's 10,000 plus the 40,000 equals the $50,000 in provisional income that you see right there. Now we have to apply it against those thresholds that we just learned about. In this case, 55% of the benefit is taxable. Now, let's just say the younger spouse now turns of age to start claiming Social Security, and by gosh, it's also 20,000. So it's 40,000 combined coming from Social Security now. So remember, they only need 60. So the other 20 is coming from their IRA. Now, if you take half of 40, that's 20, and then add another 20, that's only 40,000 provisional income, not 50. And so when we do this math again, we have the first threshold that we hit, it's $8,000 over that first threshold. Take that times 50%, that's $4,000. Well, we didn't hit the second threshold. because our provisional income did not hit 44,000. So there's no extra math there. So our total benefit that's taxable is now only $4,000, which means now only 10% of our Social Security is taxable. So guys, that is why it's important to figure out or to come up with a tax plan when you are also coming up with a Social Security claiming strategy, because that's a big difference, having 55% of your Social Security taxable versus 10% of it being taxable. That's a big difference on the bottom line, guys. Think of it if you're in the 10%, 12%, 22%, 24%, whatever tax bracket that you're in, that could be a big deal. So now the 10 most tax-friendly states in no particular order. So these are the ones that don't tax Social Security at the state level. Be Tennessee, Arkansas, Arizona, South Carolina, Colorado, where my parents just bought a mountain home, Nevada, Wyoming, Washington, D.C., Hawaii, and Delaware. And the link to the Kiplinger article where I found these tax-friendly states is in the description. So next week, we're going to be going over how much tax you could pay without proper tax planning versus how much you could save with proper tax planning. So as always, if you want more confidence in your retirement, our contact information and calendar link are in the description. And don't forget to smash the subscribe button, hit that notification bell so that you can be notified every single week when we put out new content. And also remember, we do have another YouTube channel for our podcast called Retirement Rescue Radio, where we dive deeper into a lot of these topics in long form. And we're always just trying to bring more content to help you live the retirement that you deserve. So thank you, and we'll see you next week. Take care.